The bond market is screaming, watch out, while the stock market is saying, party like it's 1999. Who's right? Only time will tell. But in this video, we're going to break down exactly what's going on so that you can make better decisions. We need to know the truth so that we can look at this in a whole different way. And I'm going to show you that right here and now. The first thing we need to touch on is, while the deeply inverted yield curve has stoked anxiety among investors about the prospect of a recession, Goldman Sachs has a different message. Stop worrying about it. This is hilarious. We don't share the widespread concern about the yield curve inversion because this time, in fact, it's different. What is this all about? It's basically the perfect indicator of a recession. But of course, this time is different. Yes, all of the other times before, it was a problem, but not this time. Okay, sure. Well, the truth is we don't know what's going to happen this time, but are they going to admit a recession? You are looking at different economists saying, I've scaled back on what I believe is going to turn out in this case in 2023 into next year. It's probably not going to be so bad. What do you think? Do you believe that we are going to see major deflation in asset prices and widespread job losses? I want to know what you're thinking. Put that in the comments below. Let's have a discussion about it. It's extremely important that we see all the details. Now, that's one indicator, but there's 1,000 indicators that we could be looking at. Let's talk about some other factors. You could see this. The green line is, of course, the S&P 500. And what the other line you're looking at there is essentially, think of that like the bond market, okay? So these two have diverged quite a bit. And, there would be times in which they're moving together, but now that is not the case. One of these is right and one of them is wrong. Which could it be? We could see that they potentially could converge into each other. Okay, or we could see a real big problem occurring. Now, what I see is generally there are times in history where things get out of whack and certain indicators go one way, the other one goes the other way, but eventually they revert to the mean. And this reversion to the mean takes place at a time in which, nobody would have expected it. Everybody says one way. That's usually when it takes a turn. I've seen this myself so many times in history. It's always when you least expect it. Isn't that how life is too? Everything's riding fine. Oh, it's all good. And then you get a flat tire. Uh-oh. Now suddenly all my plans have changed. I was going to get there 15 minutes early and now I'm going to be an hour late. Well, that means I've got to make a phone call because now this plan and that plan has been turned upside on its head. That's how life is. And in many times, that's how the financial system is too. So keep that in mind when you are making your plans, when you are looking at your retirement, or maybe just your, the way that you intend on investing, that plans do change and things change in your life. Well, of course, they're going to change in the financial system too. Look here. Wall Street banks' residential mortgages face U.S. mandates exceeding global standards. They're trying to tighten up on the rules because of what happened in the bank crisis. However, even if they do tighten up, you still have an underlying problem. You still have an issue where they were borrowing for cheap. They were trying to get yield, buying into mortgage-backed securities, all these different things. And now it's very expensive. Those assets that they bought are no longer worth what they did before. They have a problem. They can't get around that. But now we're seeing kind of like a cover-up in a sense, okay, from all of these big institutions. Not the banks. The banks are just, they're just doing what they're told. It's the governments, the regulators, and so on. It feels different than prior cycles. You're going to see a lot of defaults. So what they're talking about here is a $500 billion storm of corporate debt distress that's already starting to make landfall across the globe. The tally is all but certain to grow, and that's deepening worries on Wall Street by threatening to slow economic growth and strain credit markets just emerging from the deepest losses in decades. You see what's going on here? Of course, this is a problem. They mention it here. You raise interest rates, you create this issue because of the inflationary factors. But you see, now we're being told that inflation is going down. I reported just recently that when you look at inflation, it's a year-over-year statistic. So we have now come off that peak. So the expectation, in fact, is that we can go sideways or up in a year-over-year way. It all depends the month-over-month way because depends on data we're looking at and how far it goes down, all these factors. That's going to change things because when they're looking at this, they want to get it to 2%. All the central banks, oh, we want 2% inflation, 2% inflation. So they're all trying to achieve this by increasing their interest rates to a certain level, which is all considered to be restrictive on a global scale. So what we have here is a problem with $500 billion in the corporate debt markets. That's just one. That's just one aspect of this. So what happens as they need to roll all this over? They got to borrow at a higher rate, but less credit is available now than it was before. This is particularly on the business side, the, venture capital. It's not necessarily like, you're going to go borrow to buy a home for, a 30-year mortgage. Not the same case, okay? But this is certainly a problem on the commercial side. Let me tell you about that, okay? And I know exactly what's going on the inside there. The uncertainty over capital rules has created a chilling effect that could put a lid on mergers, while rising interest rates and looming economic downturn could also damp activity. It's an unhealthy environment because banks in distress may be forced to sell. So now what's happening here is you got all these banks in a crisis, but you don't have the availability of capital. Do you see what's going on? So you have this constriction, this tightening in the availability right now. But at the same time, you might have a bank that is desperate to sell. So they're going to be sold for pennies on the dollar. And some parts of these things are just not going to be worth it for a company. They'll say, you know what? Forget it. It's not like these companies use the cash on hand to go, like JP Morgan's not going to necessarily just get a whole bunch of cash from its checking account and then buy a company with it. It may not do that. A lot of times they get debt and then they purchase, but the debt markets are tight right now. So you see this as an issue in so many different ways, affecting a lot of different companies, even big. But of course, the weakest link right here, of course, no question, regional banks. Watch your exposure to regional banks, if any. I would be very concerned about that. I'm not necessarily worried about deposits because they've made it clear even the uninsured deposits, they seem like they wanted to bail those out. But I am concerned about the banks in general and the potential for a bank holiday. So your money is just locked out. You can't do it. You're going to line up just like they lined up at SVB, the few people that were using that. And, are you going to get your money? Well, when they decide you can have your money. And that's a problem. That's a big issue. Just being locked out for a few days could be potentially even a life or death situation for some people. Janet Yellen called for more work to reform the World Bank and other multilateral development banks, saying capital increases would be on the table only after they undertook changes to expand their capacity to help countries tackle climate change and other challenges. So if you want more money as the World Bank, you remember, you the individual, you're putting money into the World Bank, the IMF, all of these things. That's your tax dollars. And if they want more money, because they're going to get it, well, then they have to deal with climate change. Excuse me? What does the World Bank have to do with climate change? What does the IMF have to do with this? They're bringing this, whatever you think about it, doesn't matter. What I'm talking about here is that your tax dollars are going to go to this institution of unelected individuals, and they're going to be dealing with climate change. Is this odd to you? Doesn't that just make you sort of pause for a second and think, whoa, where are my tax dollars going exactly? And then you start digging in. So we can see all along here in the financial system, something stinks. They've got a crisis happening right now, and yet more money is being funneled into things like the World Bank. We know something is going on. More Americans are getting turned down for loans, according to the Fed data. You may have seen this as well. It's connected with this. which the bank had reported that across a number of fronts, credit was the hardest to get in years, with fewer people seeking out loans, at least for now. The bank said that the overall rejection rate for credit applicants rose to the highest level since June 2018. That's 21.8%. Broad-based across age groups and so on. So what we're seeing here, people, they can't get the credit they want. Credit is tightening. There's no question about that. I've seen different statistics that basically point to the same situation. That's the circumstance we are in today. It shouldn't be a surprise to anybody, but that essentially slows things down. Now, this might slow inflation down, but it also slows down the economy in general. So that's the thesis for recession. And the point here, the reason why this is important, doesn't matter if they necessarily call it a recession, but you got to understand, these businesses that are hiring people, the businesses, the JP Morgans, the Microsofts, all these companies, they go based on that data, the official data. And so if they say, oh, it's a recession, it's on, well, then companies might say, we're going to do a hiring freeze, we're going to fire some more people, we're going to do this, oh, it's a recession, and then it becomes a self-fulfilling prophecy. So it is, in a sense, important, but just not in reality, if you know what I'm saying. How this is talking about AI, okay? They're saying you see it in the news all the time. There's all these different AI things. AI is all over the place. And while obviously it is being integrated in many different places, it's not like a new thing. It's just ChatGPT became so popular because of the way that regular people could interact with that AI. It's not new. There's nothing new about what they call AI. But anyway, some have said that this is really a lot like the dot-com bubble. And that's the thing. People are funneling their money. They barely have any in some cases. They barely have any and they're putting it in. Why? Because they're trying to get something out of this market. And they're desperate. Many people are really, really desperate today. And interesting note about what's happening inside the banks, what we found is that our larger clients, and we primarily have large, sophisticated clients, are quite active in thinking about their alternatives. This was accelerated by the swiftness of the cycle and the place that we've come to and the speed. Essentially just saying you got a lot of problems. The banks are not given the yield that they would like. The investments aren't given the yield. They're trying to look elsewhere. So right now, all I'm saying, financial system is completely out of whack. We got elements from 2000, got elements from 2008. Neither of these circumstances ended up well. So what do you think? Okay. People are paying down the debt. I think that's important, whether that's Europe, whether that is in the US. And so for most people, what you got to do is you got to pay down your bad debt. If you can, do whatever you can to pay down your bad debt. You got to look at your personal circumstances. What can I do about this situation? Of course, you could try to increase your income and get a raise if that works. Maybe you got to do a side hustle. Maybe you got to do some things. You got to wash some windows. Maybe you got to clean some cars. Whatever. I've done all kinds of things just to make it happen. I used to work 3 jobs at one point just to do what I got to do. Especially when you're younger, you can do that. But hey, we all got to do what we have to do to pay the bills. And so that's one thing that's going to allow us to hopefully cut down the time to pay down that debt. We also want to be able to do what we can to have geographical diversification. This is really important. Talk about it in the mentorship class every single time. Geographical diversification is essential, and that allows you to, if your personal circumstance in your economy around you starts to fall apart, you can get up and go. And that is a very underrated part of what I would consider to be investing, because everything in a sense is an investment. So that's the way I look at it. I hope that you found this informative. You've got to hit that thumbs up button. Very important to do so. If you want to join like-minded people for free, so cool, you could check out the Discord down below, where every single day I'm in there, and we got people all over this that are sharing information. I'm bringing as much as I can in there. I got a lot of stuff and more to come, and don't let anybody tell you this. It's a secret, but I'm gonna do some giveaways, so you might want to get on the Discord. Giveaways are coming. I'll see you on the next one. Take care.